What if I told you that one conversation at a teller window could save someone thousands of dollars? Every day, bank tellers stop scams, detect identity theft, and protect customers from fraud they don't even realize is happening. In many cases, the teller is the last line of defense before the money is gone forever. Today, we're going behind the teller counter to learn how banks detect fraud, identify scam victims, and protect vulnerable customers before it's too late. Welcome back to A Day in the Life of a Bank Teller. In previous episodes, we've explored teller operations, cash balancing, and managing busy banking days. Today, we're covering one of the most important responsibilities in modern banking: fraud prevention. Most people think tellers simply process transactions. In reality, tellers play a critical role in protecting customers, identifying suspicious activity, and helping prevent financial crimes before money leaves an account. Every year, consumers lose billions of dollars to fraud, scams, and identity theft. That's why fraud awareness is a core part of teller training. A successful teller must be able to recognize warning signs, verify customer identities, and know exactly when to escalate concerns. The goal isn't just protecting the bank, it's protecting the customer. And sometimes, one simple question from a teller can prevent a devastating financial loss. Let's start with some of the most common fraud schemes tellers encounter. One major threat is identity theft and account takeover fraud. This occurs when criminals use stolen personal information to access accounts, impersonate customers, or open new financial products. Another growing concern is social engineering. These scams manipulate victims into willingly sending money to fraudsters. Examples include romance scams, grandparent scams, fake tech support scams, and money mule schemes. The challenge is that victims often believe they're helping someone they trust. One of the most valuable skills a teller develops is recognizing suspicious behavior. Sometimes the warning signs are transactional: large, unusual withdrawals, unexpected wire transfers, account activity that doesn't fit a customer's normal pattern. Other times, the warning signs are behavioral. A customer may appear nervous, avoid questions, become aggressive when asked for identification, or seem unfamiliar with their own account information. Experienced tellers learn to pay attention to both the transaction and the behavior surrounding it. Fraud often leaves clues before it leaves the account. Many scams follow a predictable pattern. That's why tellers are trained to recognize common red flags. One major warning sign is urgency. Scammers often pressure victims to act immediately. Another red flag is secrecy. The victim may say they've been told not to tell anyone about the transaction, and certain payment methods deserve additional scrutiny. Wire transfers, gift cards, and unusual payment requests frequently appear in scam situations. When multiple red flags appear together, it's time to slow down and ask questions. Some customers face a higher risk of financial exploitation. This includes elderly customers, individuals experiencing cognitive decline, customers facing language barriers, and those who appear confused or distressed. Tellers are often in a unique position to notice these warning signs. A new companion suddenly controlling conversations, an older customer appearing fearful, someone struggling to explain why they're withdrawing large sums of money. These situations require patience, empathy, and heightened awareness. Sometimes protecting a customer means slowing the transaction down long enough to understand what's really happening. Identity verification is one of the simplest and most effective fraud prevention tools. Good tellers don't rush this process. They examine identification carefully. Look for signs of alteration or tampering. Compare information across multiple sources when available, and use verification tools provided by the bank. What should never happen? Accepting damaged or expired identification without proper review, or ignoring discrepancies because the branch is busy. Fraudsters count on shortcuts. That's why strong verification procedures remain critical. Elder financial abuse is one of the fastest growing forms of financial exploitation. Warning signs can include unexplained withdrawals, sudden changes in account activity, a new caretaker controlling financial decisions, or a customer who seems confused about where their money is going. When tellers identify these warning signs, they must follow established procedures and involve appropriate fraud or compliance personnel. Protecting vulnerable customers is one of the most important responsibilities in banking. One of the biggest misconceptions about fraud prevention is that tellers are expected to investigate fraud themselves. They're not. Their responsibility is to recognize concerns and follow the proper escalation process. First, verify information internally. Review account history. Check identification. Confirm transaction details. Next, notify the appropriate fraud or compliance personnel. Finally, document everything accurately. Good documentation helps investigators understand exactly what happened and why concerns were raised. Let's look at a real-world example. A customer requests an urgent wire transfer for more than $4,000 to an unfamiliar overseas recipient. The customer appears distressed, claims there's a family emergency, and asks the teller not to tell anyone. Immediately, several scam indicators appear: urgency, secrecy, emotional pressure, and an unfamiliar recipient. Instead of processing the transaction immediately, the teller slows things down, asks questions, and follows escalation procedures. The result? The scam is uncovered, and the customer's money is protected. This is exactly why fraud awareness matters. Let's review the most important lessons. Stay alert. Fraud can appear in any transaction. Protect vulnerable customers. Take identity verification seriously. And never hesitate to escalate suspicious activity. Every transaction presents an opportunity to protect a customer from financial harm. The best tellers don't just process transactions. They help safeguard trust. Here's something to think about. If a customer appeared nervous, insisted on secrecy, and wanted to send money immediately, what questions would you ask? And what warning signs would make you pause the transaction? Understanding fraud isn't about memorizing rules. It's about learning how to recognize patterns and respond appropriately when something doesn't feel right. Fraud prevention is a team effort. Tellers are supported by branch management, fraud officers, compliance teams, internal policies, and ongoing training. No employee is expected to handle suspicious situations alone. Knowing where to turn for guidance is part of being an effective banking professional. Fraud prevention isn't just a banking responsibility. It's a customer protection responsibility. The more knowledgeable and observant a teller becomes, the more customers they can help protect. Stay vigilant, stay informed, and remember, sometimes the most important transaction a teller handles is the one they stop. If you're interested in banking careers, fraud prevention, scam awareness, identity theft protection, elder financial abuse prevention, and learning how banks actually work behind the scenes, subscribe to Jay Get It. And in the comments, have you or someone you know ever been targeted by a scam? What was the biggest warning sign? We'll see you in episode 5.
This content is for educational purposes only and is not financial, legal, or investment advice. Please consult a qualified professional before making any financial decisions.